What's up guys, my name is Caleb and welcome back to my channel. In today's video, I'm going to show you exactly how to get the biggest bang for your buck when it comes to investing. Now, when people download an app like Acorns and start to get into investing, the first questions I usually get asked are how often should I invest and how much should I invest? So I'm just going to pull up my iPad on the screen here and just walk you through a couple of different investment strategies. I'm going to be talking about dollar cost averaging, and I'm going to be talking about lump sum investing and basically comparing and contrasting the two. So essentially what dollar cost averaging is when you buy into the market a consistent dollar amount over a period of time. So compared to lump sum investing, obviously that would be investing all at once. So let's pretend we have like just a standard little stock chart here. So if you were to invest a lump sum, say you had $500 to invest, in order for you to know when to get the best deal, which would obviously be these bottom points because you're getting the cheaper price, so you're getting more shares for a cheaper price, you would have to somehow time the market, which is basically impossible. And if you tried to time the market and you happen to buy at these points right here, then you're getting a horrible deal. So essentially what dollar cost averaging does is it prevents the bad timing, and it also prevents the emotional aspect of investing because you know that you're just going to keep buying in no matter what the price is. And so with dollar cost averaging, you would basically be, buying here, 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 etc. all throughout, and you would be spreading that same $500 throughout the entire duration of the period. So for example, we could say this is like 1 year. So that's essentially what dollar cost averaging is. So the pros of dollar cost averaging, like I said, it reduces the risk of bad timing, so you avoid the bad timing of buying at the peak of the market, and it also makes it so you don't have to guess when the bottom of the market is. On the contrary though, the cons of this are you could miss out on potential higher future returns, and it's also not a universal solution for all types of securities. The times that I would use dollar cost averaging are more when you're contributing to like a retirement, for example, like a Roth IRA or a 401k, or if you're buying stocks that you're going to plan on holding for 10 to 20 years. This is not a strategy that I would use for speculative stocks and things like maybe cryptocurrency or individual stocks. I wouldn't necessarily use this because, for example, I'll draw another little chart here real quick. If you have a stock chart and it ends up going down over time, excuse my drawings by the way. So for example, if you're buying throughout this, but the security still has a downward trend, then it doesn't matter how much you dollar cost average, you're still going to be losing money over time. Whereas with the S&P 500, the S&P 500 has an average annual return of about 7%. So if you pull up the S&P 500 chart for the last like 20 years or so, you'll probably see something like this. And then we have the crash in 2000, then we have the crash in 08, and then it kind of steadily goes, and then we have COVID right here. And as you can see, over time, there's a general upward direction. So that means that even if you were buying at the peaks of these three right here, right before the crashes, as long as you continue to keep buying after it goes down, you're making a gain on every single chunk that you invested. So here is an example to kind of better paint a picture of how you can get a better deal, because if you're investing for the long term and you're investing in your retirement, the goal is to get the best deal for the stocks and stuff as you can. So a lot of people think that when a stock goes down in price, that's like bad because you're losing money. But if you are viewing it over the long term, a stock going down in price just means that you can get more shares for the same amount of money because you're getting a better deal. So say for example, you decide to put $100 into something all at once, and the price of the shares is $10. So doing the math there, obviously you would end up with 10 shares. Now say you take that same amount of money, the $100, but you divide it up into $20 increments, and there would be 5 of them, so $20 invested 5 times. So say that each time that you invested, the first time it was $10, then it was 9, then it was 8, then it was 11, and then it was 10 again. And for example, let's say that these are each a different month or something that you invested, maybe the first of the month. So the amount of shares that you would be getting would obviously be 2, because $20. And then when it drops to $9, you would be getting 2.2 shares. $8, you would get 2.5 shares. Then you would get 1.8 shares for $11, and then once it's back at $10, you would get 2. Basically, what we can derive from this now is because of the market fluctuations and how it went down to $9 and $8 and $11, the average price that you were paying throughout this entire duration here is $9.6. So already this 9.6 number is a better deal than the $10 we were paying with the lump sum. And then on top of that, the amount of total shares you now own after all of this would be 10.5 shares. So not only are we getting a cheaper average price of 9.6, but we're actually getting more shares at the same time. So this is an example of when it would be good to dollar cost average. Now, this is also anticipating that in the future, the price of this stock is going to be like $15, $20 or more. Because if in the future, you know, this dropped down to $5, 9.6 of an average price isn't that great. But if it went up to $20, 9.6 is better than 10. So that's kind of a different way to look at it. I just realized that my face is actually covering part of my diagram here, so I'm just going to switch that to the other side for a sec. So there you can see the 10.5 total shares, yada yada. So now we're going to move on to the $1 million question here. How often should you invest? It really just depends. So like I said earlier, so say you have like $500 to invest once again, and you decide to just pick a random day out of the year. Let's say that from here to here is 1 year once again, and you happen to buy when the market's at its peak. When your investment goes up in value in the future, you're only making this gain. Whereas if you were somehow able to time the market and you bought right here, you'd be able to make twice as much money. That is why I would not recommend investing as a lump sum, and why I think it's better to spread yourself out a little more thin. So now let's bring up a different example of investing monthly. So if you were to invest monthly, the same thing kind of applies. So it's a little better, but say for example you invested on the first of the month, and for whatever reason you just got really unlucky, and the first of the month happened to be on the top of these peaks every single time. The gain that you would make by the time it goes up in value in the future, it still wouldn't be nearly as much as if you were catching all of these bottom peaks down here. Furthermore, you could invest weekly. So if you're investing weekly, and this is the duration of a year, you would have, 52 different white lines on here, and you're catching the move of every single part of the market. And so you're kind of getting the overall just average line here, as far as like how good of a price you're getting on the shares. So weekly is what people typically do. That's how a 401k usually works. It's weekly or bi-weekly depending on how you get paid. But if you have a 401k, you're actually already dollar cost averaging, because you have a percentage of your paycheck coming out and being invested on your behalf. What I would recommend, and what I personally do with my Acorns account and my Roth IRA, because of the fact that I want to capture every single movement in the market here, and I want to get every single day, every single drop, every single gain, I would invest daily. And you can only do this on a couple of apps to my knowledge, unless you do it manually with like Vanguard or Fidelity. But I love Acorns because it gives you the option to invest the same amount daily. And this is great because if you have, let's say for example, throughout the year, let me just get rid of like a part of this graph for a second. Let's say you're investing throughout the year and you're investing every week. But then we get to this little part in the year and we have this one day where it just like, the graph just goes crazy. There's like a weird market crash for like a day or two or something. And say that this happened on a Wednesday, but when you invest weekly, you're investing on Mondays. So you would be missing this amazing price down here, because you are getting a steal at the bottom of this valley right here. You're getting such a good price on the investment. And this is why I would invest daily, because if anything like that happens, you are just capturing every single day of the market. And yeah, that's why I would recommend to invest daily. So how much you should invest. Now there's 3 different options. You could invest a percentage of your income. So say that you make $500 a week and you invest 10%, that would be $50 a week. You can invest a flat amount. So if you make $500 this week and you make $700 next week, you still could invest just a flat solid amount of say like $40. Now the other thing that you could do is value averaging. Now this is a little more of a complex way of doing it here, which I don't recommend you start out doing this, because you need to kind of know a little bit about how the economy works and different market cycles for this to be effective here. But essentially what this means, let me just draw another quick graph again. Say that you're still investing daily, but when you get up to these peaks right here, you reduce the amount that you're investing. So say on my Acorns account, I have it set for $10 a day, and that's kind of like the average amount that I'm aiming for. Say that I reduce it to about $5 the higher it goes. So every time it is like on a pretty good incline for a couple weeks, I slowly reduce it down to $5. And then every time the chart goes down to these valleys down here, I increase it to $15 a day. So that means that every time that the market is like a better deal, I'm putting more money in proportionally. And then when the stock is like a bad deal, I'm putting less money in. So this is kind of an effective way to do it too, because then you kind of amplify the deal that you're getting in these valleys here. And yeah, so this would be a great strategy for the S&P 500. Now, yeah, just like I said, should you invest daily? I think it really depends. If you are investing for the long term and you don't plan on touching your investments for a really long time, I think investing daily is a great option. I don't think that you should invest daily if it's a speculative asset or you are unsure of if the price is going to go up or down in the future. Now with the S&P 500, there is an average annual return of about 7 or 8% historically. It's been like this for the last several decades, and I personally anticipate this to continue. But if it's a stock for a random company, like an individual company, and you don't know that much about them, I don't recommend investing daily. Or dollar cost averaging. It really is up to you, but obviously this is the most effective the more confident you are that the asset is going to go up in value over time. Now, if you're wondering what platform to go to invest daily, what I recommend is Acorns, and you can definitely check out my previous video on Acorns. I have a complete overview of the entire app, and I explain all the different features it has. So go check that out first, and then what you can do is you can just make an account, and there's an investment account, and you can set it to $5 a day at a minimum, which is only $150 a month. And this is just a really good strategy in my opinion. It makes sure that you get every single day's snapshot of the market, and you get the overall average price over time when you're buying into it. I hope that all made sense for y'all. If you have any questions, please leave them in the comments below, and I'll be sure to get back to you as soon as possible. I know that some of the stuff was kind of confusing, but I would be happy to explain further if anyone's wondering. And if you enjoyed this video, please leave a like down below. I would appreciate that a lot. And if you want to see more content just like this, please hit that subscribe button down below as well with the little notification bell next to it. That way you get notified every time I release a new video. And with that being said, thank you so much for watching, and I'll catch you in the next one.